In today's video, I'm going to be talking about the different types of investments there are that you can use when you're trying to grow your dough in the stock market. Hello, welcome here. If it's your first time here, we make videos weekly on how you can become a better investor and trader, specifically if you're a teen. So if that's something you're interested in, just a quick tap on that like button would be so much greatly appreciated and would help us make more of that content for you. And yeah, that's it I really want to say. In today's video, we're going to be talking about the different kinds of asset classes or investments, call it what you want. And the first one we're going to be talking about is stocks. Sorry, last outdated meme. Now, if you're wondering what this pile of books is all about, this is just how I keep myself entertained during shelter in place. So let me know what you're doing in the comment section below. Okay, back into the video. So really what stocks are is that they're a piece of a company, and a lot of you guys, if you guys are interested in investing, probably know this already. So because of that, I'm gonna try to add some little more fun facts and go a little deeper to just make this a little more valuable and meaningful for you. So just hang in there. So really, it's a piece of a company, and some of you guys may have heard the word share. Now, the word share means like you have a piece of a company, kind of like you have ownership or you have equity in that business. So you can say I have a share of Disney, same thing as saying I have ownership in Disney. And just so you guys know, the word share and the word stock are highly interchangeable, and so you guys may hear one or another, so don't think that they're any different. Now, one thing that I'd like to tell you guys is that stocks are so much more than a simple price point. They are a performance metric, and you'll see this in practice once you start reading the news. For example, to provide a relevant example for you guys, during COVID-19 right now, Amazon and Zoom are doing so well. So how do we track how these companies are doing so well? Well, these companies may not release like a profit report every single week, but they are public companies. So for example, ZM and AMZN, that's their tickers respectively for Zoom and Amazon. There'll be articles written about how Zoom went up 100% or how good Amazon is doing. And that's really just to show that it is a performance metric on how well a company is doing. And the reason companies give out shares in the first place is this. Let's say you're the CEO of this highly valued startup and you want to build more products. Except you could go two ways. You need to raise the capital or money in order to fund the new research and development, or R&D as you could say in business. You need to fund the R&D, and there's two ways you could go about doing this. You could do it the old-fashioned way. You could drive down to Sand Hill Road, and then you could talk to venture capitalists and investors, and you can raise money. However, that's going to take a long time with the paperwork, the signing, the negotiation. You get it. However, with the expansion of the internet, public companies like Apple and Amazon can raise billions of dollars in just 1 minute or less, and that billions of dollars could be used to funding more projects like $700 wheels, for example. So because of that, Apple and Amazon and other big companies that are public can raise capital almost instantaneously, whereas if they were to do that process the regular way, like by going to Sand Hill Road or other investors, it would take a lot longer, and that's really the beauty of the stock market. The next topic we're going to be going over is bonds. Now, I know this video may have alerted you because you're investing in the stock market or whatnot, but I really do feel this is important as it is a part of asset management, which we will cover in future videos, and the power of diversification. So bonds are really crucial to that, and stay tuned until those videos come out. Now, really, what bonds are is the best way I can explain to you is it's an IOU plus interest. For those of you guys that don't know what an IOU is, you simply just have to say it out loud to understand it. I owe you this sum amount of money. So take a look at this photo of an IOU right here. This tells you the amount you owe, and this tells you the date you have to give it. So here's an example. Let's say there's these limited edition sheets, but you can't pay them. And this is in the old-fashioned days. They're limited edition, but you just don't have the $50 on you to pay it, to pay for it right now. But you know you're gonna be getting your paycheck next Friday, and then by next Friday you can pay off that $50. So what you could say is you could tell the owner, hey, I don't have the $50. Here's an IOU. I owe you $50. I'll give it to you by next Friday, and then I sign here, you sign here, and it's pretty much just like that. Now, the only difference between an IOU and a bond is interest. The thing is that in an IOU, you're just saying I need $50, and then once you have that $50, you pay it back to the person. You don't pay any interest or any more money other than that $50. Well, then there's no profit, right? So that's where bonds come in. Bonds are like IOUs. They're lending money to somebody else, and they're gonna pay back that exact same money plus interest. And this is all predetermined. So here's the technical terms for bonds. So first is we'll go over this maturity date, which is basically saying I'll lend you this $100, you pay back this $100 by this date, and it's predetermined again. Next is the interest or yield, and so you can say I'll pay you this $100, you have to return 103, so you have to return $100 plus 3% of the original amount I gave to you, and that 3% is called the yield or the interest. And so really that's the main difference between a bond and an IOU. And I do want to elaborate on this example, so I will be showing it on my computer right here. So here we're looking at the Apple 1727 bond. First we'll decipher this and then we'll go down Markets Insider's website. So 1727 means you buy in 2017 and then you get your money back in 2027. So it's a 10-year bond. Pretty easy to understand. Now, really, if we look here, this 109.04 lets us know that this bond in 2017, or currently as it is right now, it costs $109.04. Now, bond prices do change, here we can see, clearly is changing, but this is telling you that in a bond, for example, here, you're saying, Apple, I'll let you borrow my $109.04 cents, and then by 2027, you have to pay back this original money plus an interest. The interest is also goes by the name yield. So just here, if we just really hunker down on the data here, look at the yield right here, okay? So this is the yield, sorry about that. This is the yield, 2.25%. So it's saying, I'll pay you this amount, you give it back to me 10 years later in 2027, and plus 2.25% of whatever I gave you in the first place. So if that was $10, if I was asking for $8, for example, I was saying a bond for $8, it would just be here's $8, now return that $8 in 10 years with, I don't know, $8 times with $18, I hope. Okay, yeah, that's really what I'm trying to say. So there really are only 3 types of bonds, and you've already seen one. So the first one we're going to be talking about is treasury bond. It's given by the government for them to do governmental work. I don't know if that's a real word, but really it's just for stuff like social security, education, infrastructure, that kind of stuff. Next, the other 2 bonds are corporate bonds and municipal. Corporate, you already saw, it's the Apple 1727 notes. It's for them to be able to raise money. And then municipal is used by banks because banks need money in order for them to lend it out to those who are using their services. Now, this is where we go just a little bit deeper. Why would a company use bonds rather than shares or stock in order to raise money? Now, the reason Apple would give bonds in the first place is because it needs to raise capital. But why wouldn't they use stock? Well, let's say you're the founder and CEO of this very highly valued startup, and you own 51% of the business, or you have stake equity 51%. Now, that's operating control, and you do not want to lose that. Now, what could you do to raise money? You need to raise money for this new product. You could issue out stock, but you're going to lose that ownership. Because remember, when you're investing in stock, you're giving money to somebody else, but you're also taking equity and ownership in their company. However, for bonds, you're giving money and it's a loan sort of format, so there is no equity that is lost. So the founder and CEO of that startup, that's you, you may decide, hey, I want to keep operating control, so let me use bonds instead of stock, because bonds, I won't have to give out any ownership, and I'll still be the majority shareholder with that 51%. Now you guys have learned a lot. You've learned about stocks, bonds, mutual funds, and indices, which is the plural form of index funds. And the last thing you really have to cover is an ETF. An ETF is pretty much the exact same thing as a mutual or index fund, except for one key difference. So here we're looking at Google stock. And I know this may seem a little bit insignificant, but I just want to point out one crucial detail that will help you understand the key difference between ETFs and mutual funds. So here we're at this one day, and we're in Apple stocks, and we can see that Google is trading throughout the day. So here at 12:40 p.m. it's trading, at 11:20 it's trading, at 2:24 p.m. it's trading. And when I say trading, I mean that its price point is changing. As we can see, Google's price point, as every other stock, changes throughout the day. This price changing is known as intraday trading because it means that the price is changing throughout the day as people are buying and selling throughout the day. Now, here's an example of a mutual fund. This is Dodging Cock Stock Fund. And we can see here, there's no one-day tab. That's not an accident. That's because mutual funds do not trade throughout the day. So here we can see the price point clearly gets updated when the stock market opens every single day at 9:30 a.m. So May 11th at 9:30 a.m., the price point is 150.87. Today, May 12th at 2020 at 9:30 a.m., the price is 147.51. And so we can clearly see that it gets updated at 9:30 a.m. every single day. Well, what's the solution? Where's the two? Why can't we have funds like mutual funds that track industries but trade throughout the day? Well, that's where the solution of ETFs come in. ETFs are mutual funds kind of, in which they have pooled capital, pooled everything pretty much. It's pooled capital made by brokerages, it's then divvied up, that kind of thing, except that it trades throughout the day. So if we look here, don't get intimidated by this jargon. This is VXUS. It stands for Vanguard, which is the brokerage that makes it. Total International Stock Index Fund ETF shares. This means, I like to summarize this, it means that it's tracking how the international stock market is doing because it's an index fund. And here we can see that it does have a one-day tab. This is not an accident. Again, it's an ETF or an exchange traded fund, which means that it goes through intraday trading where it's trading throughout the day. And that's really the key difference between ETFs and traditional mutual funds. ETFs trade throughout the day and have intraday trading. Mutual funds do not. Well, you may be asking yourself, what's the big deal? Why does it matter that ETFs trade throughout the day and mutual funds do not? Well, think about it if you were like an equity trader on the New York Stock Exchange floor. You want to get in and out of the market as instantaneously as possible. However, let's say there was a stock market crash. You would want to sell as fast as possible, but unfortunately, if you invest in a mutual fund and there was no such thing as ETFs, you would have to wait until the end of the day and until 9:30 a.m. the next day for your order to be filled and for you to successfully sell the stock. By then, who knows how much the stock market may have dropped. Whereas if it's an ETF, like a stock, you can instantaneously just get out of the market when the stock market crashes and not lose any further money. But if it's a mutual fund, well, you have to wait until 9:30 a.m. tomorrow for your order to be filled, and you're probably going to lose a lot more money. So you guys learned a lot. You guys learned what a stock is, which is an individual piece of a company. You guys learned what a bond is, which is like if an IOU had interest. And you guys also learned about mutual funds, pooled capital, then divvied up and then put in the public exchange, indices, set it and forget it, and my personal favorite, which is an ETF, which is like if a mutual fund and a stock had a baby. And yeah, that's really it for today's video. Please like, that really helps with the YouTube algorithm. Subscribe, I upload weekly on this kind of content to help you make more money. And yeah, that's it. Please share this channel with your friends and comment down below what you're doing during shelter in place. And thank you for watching as usual.